Hi everyone, welcome back to the audit and attestation class. In this class of specific matter that require special audit consideration, we'll be covering the topic investment in securities, including derivative instrument. So let's dive into for more detail.
The next topic is investment in securities. So investment in securities and derivative instrument. Investment in security when valuation is based on investee financial statement. That is equity method of investment for consolidation purpose. What all things as an auditor we need to keep in mind, what all things as an auditor we need to perform. First is obtain and read available financial statement of the investee and accompanying audit report. For example, here, let's say you are XYZ Limited. Maybe let me present a small scenario. So let me present whiteboard. Can you all see my whiteboard?
Yes, sir.
So let's say, for example, this is ABC Corporation. And it has equity method investment. And let's say XYZ Private Limited. This is in USA. This is in, let's say, India. Right. So here in this equity method of investment, what all things, how this company auditor, how the CPA of this company gain the comfort over the valuation of investment. Let's say they have made $100 million investment in this company and they acquire, let's say, 100% equity in this company, right? How this CPA will ensure this $100 million is appropriate, there is no impairment or there is no less value, right? So that is something we'll be learning over here. So now let's come back to the notes. So here, obtain and read available financial statement of investee and accompanying audit report. First thing what you will be doing, you'll be looking at the financial statement of the investee. Which one is investee? XYZ Private Limited in India, right? Makes sense?
Yes, sir.
Yes, sir.
So first you will be doing, taking the financial statement, audited financial statement of the XYZ Limited India Private Limited, right? If financial statements are not audited or audit report is not satisfactory, the auditor should apply appropriate audit procedure considering the materiality of the investment. If those investment is material to the group financial statement and of that company, you do not have financial statement audited, or let's say audit report is a qualified or modified audit report, and it's not satisfactory to your requirement. In that case of scenario, you will be performing additional audit procedure to gain the comfort over the valuation of the investment made in that respective company, right? Third is, if the carrying amount of investment reflect factors that are not recognized in the investee's financial statement or financial value of the assets are materially different from the investee carrying amount, the auditor should obtain appropriate evidence to support such amount and consider the impact on the consolidated financial statement. That means, for example, if in your books, the value of the investment is reflecting $100 million, whereas the actual value of the assets in that company is, let's say, $80 million. So in that case of scenario, you'll be reflecting the value of investment as $80 million, not $100 million. And $20 million, you'll be considering the impact as in like impairment loss on those investment or revaluation of the loss for the investment, right? If there is a
here, sir, we will be investigating investors' financial statement in order to assess that.
Yes, because it's coming as an asset in your balance sheet.
Okay.
Right? You'll be valuing the assets of your company. So maybe let me go back to this. 1 second. Let me go back to that. So here, if you see how your financial statement in ABC financial statement, it will be an assets, right? Which is investment in XYZ, right? This is how this 100 million would be coming.
Yes, sir.
And in XYZ and equity and ABC shareholder. Right, $100 million. Right now, this company have, let's say, losses of, let's say, $20 million. So your equity balance will be $80 million. So your investment should also go revaluation, or you can say impairment.
But sir, then what about retained earning in XYZ?
So this loss is coming from retained earnings. So I'm just doing a shortcut. This loss directly will not come. It will come from retained earnings.
No, I'm saying, sir, if XYZ has a retained earning of 20, then value will go to 120.
Yes.
So if they have, also
if,
we will be
if they have profit. If they have profit, right? So let's say $100 and $20. If they have profit, so value is 120, right? So then here, like investment in equity method, you'll be doing based on the valuation of that particular company in which the investments are being made. Make sense?
So, sir, in case of profit, will there be any impact in our ABC as well?
Yes, we'll be coming to that. Impairment loss is upfront, you'll be recognizing, but if there is a positive side of it, then how to do the accounting will be coming to that. So first, let's understand from the auditor standpoint of view, you'll be considering more risk perspective first, right? So if there is a positive side of it, it's less risk, but if it is negative, it's more risky. So you need to consider the risk-based approach, and you need to consider the impact of the loss immediately, right? So for that, we'll be coming to separate ESC, which is for the fair valuation of the investment. We'll be coming to that.
Because if we remember that in FAR, if we do impairment, we can't revalue that asset.
Sorry, if we do the
impairment, so we can't increase the value in the later year or subsequent years. So once the value is impaired.
Yes, in US GAAP. Yes, you are right.
So that's why I was just asking, because if we will upfront calculate it, then value will be going down itself. So then how will we, if in second year, if they have a profit, then how will we increase the value?
No, you are mixing two concepts here. So like in audit side will be what is being more you can say relevant for me, whether there is any loss which is being reducing the value of my assets or the investment. Now second side is the investment value, which is like increasing. For that, like we'll be keeping like book value or market price, whichever is lower.
Right.
Right. If the book value is 100 and market price is 120, we'll keep our investment at 100.
Value.
Right. If the book value is 100 and market value is 80, then whichever is lower, that is 80 is the lower.
Okay.
Right.
Yes.
Make sense?
Yeah.
So now coming to if carrying amount of the investment, look at third point. If the carrying amount of investment reflect the factor that are not recognized in investee financial statement or fair value of the assets are materially different from the investee carrying amount, the auditor should obtain appropriate evidence to support such amount and consider the impact on consolidated financial statement. So here, if you got to know like the fair value of the investee is less than the book value of the investment, in that case of scenario, you will be further investigating and looking at sufficient and appropriate audit evidence to conclude that impairment loss is required. Right? If there is a difference in the financial statement period, so fourth point is if there is a difference in the financial statement period, that means you are a parent company, you are a US company, you follow Jan to December financial year. And you have a subsidiary in India, they follow April to March financial year. So keep that financial year in mind and let's understand this fourth point. If there is a difference in financial statement period between the entity and the investee, which is for material investment only, the auditor should determine whether the management has properly considered the lack of comparability and the effect on the audit report, if any. In this case of scenario, you need to consider the impact of lack of comparability and the effect of that lack of comparability in the consolidated financial statement. For example, you are a US parent company and you have year end, let's say December 31st, 2020, and you have a subsidiary in India with the year end March 31st, 2020, and consolidation at March 31st, 2020. So how do you do the consolidation at March 31st, at December 31st, 2020? So you'll be taking signed financial statement of the Indian subsidiary for the year end March 31st, 2020, plus you will be performing roll forward procedure for 9 months, which include your test of control and test of detail for group audit for the period of Jan to December. If subsidiary is not material for consolidated financial statement, no additional procedures are required. So additional procedures are required only when subsidiary is material. Make sense? Do you understand this?
Yes, sir.
Example?
Yes,
okay.
sir.
So fifth one is consider impact of subsequent event of material equity method investment. What is subsequent events? Anyone have any idea about subsequent events? I know we have a detailed topic in the last and in the end of this chapter, but anyone have general idea what is subsequent event?
So there are two types of subsequent event. Basically, the event which happened before the closure of a financial year, but we came to know after that. And the other one is the events which come across once your closure of the year has been completed. So that and relevant to the financial year which we are auditing. So basically, these are the subsequent events. Yeah.
Yeah. Anyone else would like to add to Gurmeher? Nimisha, Kush, Sanchit.
Sir, Gurmeher explained everything.
Oh, why?
Significant material activity, significant material event that happens after the balance sheet date, or after the signing balance sheet date, but before the signing of financial statement. So And then I think he rightly mentioned there are two events. One that you were not aware but happened before the year end and you got to know after that. And the second one is that actually happened after that.
Yeah. So two things. One is subsequently discovered fact, right? So the fact which were already exist before the year end, but you came to know after the year end, but before the signing date. So that is called subsequently discovered fact. And then the other one is subsequent event that has happened after the year end, but before the signing of the financial statement. That is called subsequent event. For example, any customer has got bankrupt in the month of, let's say, January. So your year end is December and your financial statement signing date, let's say, is 28th of February. In January, you got to know the major customer has got bankrupt. So that is a subsequent event. It was not existing already there, but it's a subsequent event which is being impacting your current year financial statement, right? That is called, in that case of scenario, we need to consider the impact of the bankruptcy of my major customer, and it may result into provision for doubtful debt, increase in provision for doubtful debt. There might be case, let's say, you already have some litigation going on and the result of the litigation has been come out in the month of January or before the signing of the financial statement. So it may be in your favor or it may be in your against. Accordingly, you need to consider the impact of that. So that is called subsequent event which have material impact on the current year financial statement. In that case of scenario, you need to consider the impact of the same, right? So in equity method of investment for consolidation purpose, you'll be considering all these 5 things. One is obtain and read the available financial statement, right? Look at their financial position. If there is any impairment loss required, so accordingly consider the impairment loss. Look at the period for which they have been audited and your company has been audited. If there is a difference in the period, how do you test the difference, different period, right? Which we discuss an example of Jan to December period and compared to April to March period for 9 months, like what all additional audit procedures you are required to perform if that investment is material. And then if there is a subsequent event to those respective subsidiary or respective investment in which you have made equity based investment, consider the impact of the subsequent event as well. Now coming to the next one, investment in derivative instrument and security measured or disclosed at fair value. So what all thing as an auditor we need to perform when we are testing the investment in derivative instruments, security measured, and other disclosure of the fair value of the same. First one, the auditor should determine whether the applicable financial reporting framework specify the method to be used to determine fair value, right? So first and foremost important thing is to understand and evaluate if there is a specific method has been prescribed in any accounting standard of the respective financial reporting framework. If you are using US GAAP, any GAAP requirement, or if you are using IFRS, any IFRS requirement, to consider the specific method for the valuation or fair value presentation, right? And evaluate whether the fair value determination is consistent with the specific method or not. So if the fair value method has been defined in the respective financial reporting framework, then it's been your responsibility to evaluate whether the specific method has been used by the management or not. Second is, auditors should ensure the requirement of applicable financial reporting framework are compliant. So all the financial reporting framework requirements are being complied or not, that also you need to ensure. Third is, if fair value is obtained from the broker or dealer or third party source, right? So for example, for the listed company, value of their share, generally you take from Bloomberg, right? You take from like dealers, you take from broker statement, right? So those third party sources which you consider for the valuation. The auditor should understand the method used in developing the estimates for the fair value by the company if there is any difference in the fair value which is being coming out of those third-party sources and the value the company has considered. Second is, for example, if the shares are not listed, then what valuation method the company has used to value their investment. Understand and evaluate the valuation model and support and the assertion or assumption taken by the management for the fair value in determining and using that particular model, right? So there are three types of investment. First investment, which is like in pure stock market, or maybe which is readily available market like NASDAQ, or maybe any exchange on which shares are being listed. In that case of scenario, you can take like the valuation of those stocks from those respective stock exchange. Second is the investment in non-trading stocks, right? How do you value those investments? So there are certain model has been defined or been approved or been given in the respective accounting standard, which include like fair value measurement method, Black-Scholes model. Have you heard about Black-Scholes model?
Yes, sir.
Right. So that's also a valuation model and being very well recognized or considered in almost all the, you can say, accounting standard, whether it's like US GAAP, IFRS, or NDS, they all approve like Black-Scholes model of valuation of the investment and the fair value measurement method.
So can you brief us on that? I haven't heard this word before.
These are kind of actuarial models, is not part of your neither part of your FAR or not part of your audit, but you should be aware of like the names only. Like these are standard method, but for which like generally we involve actuarial to do the valuation.
Okay.
So Black-Scholes is basically for pension, right?
No, like it can be used for the valuation of investment, pension, warranty provisions, or sales and incentive provision. So these all are actually actuarial methods which is being used for different purpose, majorly for the valuation purpose, either of assets or the provisions. Right? Make sense?
Yes, sir.
And auditor should evaluate management conclusion about the need and recognition of an impairment loss for decline in the security fair value below the cost or carrying amount. So wherever the fair value goes down below the book value or below the cost or carrying value, then impairment loss the management has recognized, right? So you need to evaluate the conclusion made by the management, whether that loss has been appropriate, sufficient or not, or does it require more to be considered. Auditor should also obtain sufficient and appropriate evidence supporting the amount of any impairment adjustment recorded. Last one is auditor should obtain sufficient and appropriate evidence about the unrealized appreciation or depreciation in the fair value of the derivative. So if there is any unrealized gain or unrealized loss on the fair value of the derivative, then auditor should obtain the sufficient and appropriate audit evidence for the same as well. So this is about like security, investment in securities and derivative instrument. Let's do a practice question here. Informing the existence and ownership of long-term investment in the form of publicly traded stock, the auditor most likely would inspect the security or what? So what is the call of the question? Informing an existing and ownership, right? So whether the investment exists or not, whether the company have ownership or of that long-term investment or not, which they have made in a publicly traded company, the auditor would most likely inspect the security or what, right? First thing, correspondence with the investee company to verify the number of share owned. Second, inspect the cash receipt journal of the amount that could represent the sale of security. Apply analytical procedure to the dividend income and investment account. Confirm the number of shares owned that are held by independent custodian. So what you will be doing? To test the existence and ownership. For example, you are auditing a company XYZ Limited. They have made an investment in ABC Limited, which is a traded company whose stocks are being traded in the stock exchange. So how do you verify the existence of that stock or ownership of that stock with the company? Are you guys with me?
Yes, sir.
Yes, sir.
Yes, sir.
How do you verify?
By sending out external confirmation to the custodian. See, option 3 is option 3 will not give us comfort over existence or something. It's analytical procedure, so we will not get that. Option 1, I don't know. I mean, option D is there because usually when these companies trade, they would have, like similar to how we do trading using a third party or a vendor or a portal. They would be doing the same thing and sending out confirmations to them to confirm back the number of shares held would give us comfort. That's why I feel option D, but I don't know why option A or B cannot be done. So
I'm also confused with option A.
Yeah. Correspondence with investee. For example, you have purchased a share of Reliance. How do you gain comfort over the
number of shares owned? So I would be having numbers of shares now in Reliance. So that won't be held by independent custodian. That will be held by.
How do you purchase that share? Do you purchase directly from the investee, or do you purchase through custodian?
I purchase by custodian. But
how many of you do trading? Like any of you do trading?
Yeah, I do.
Yes, sir.
Yes, sir.
So how do you do trading?
Through a stockbroker, basically. The bank which we are dealing with, for which we have the demat account, that is the stockbroker, and we are dealing through that. So,
and who maintain the record of your investment?
So bank is maintaining. I can download the statements and everything from the bank because they provide me everything, and they are the brokers itself, right?
Yeah, they are the broker and custodian.
Yes. I suppose the fourth answer should be the right one because in the first and fourth answer, the thing is, first answer it says we are confirming with the investee himself that these are the number of shares.
But for example, let's say if you have purchased 1 share of Tesla, right? From where do you get like comfort over the existence or ownership? Do you go to the Tesla and request them to confirm your 1 share, or do you go to custodian?
Custodian, we go to that. That was what I was trying to say, because in the first answer it says we go to the investee company directly, and in the fourth we go to an independent custodian. We should always get to get in touch with the broker because they maintain all the records and contract notes and everything. They have that, and they have to comply with the SEBI guidelines and everything as well.
Yeah, if it is not a publicly traded stock, and if it is like a private company, then probably first answer makes sense.
Right.
Okay.
Right, everyone?
Yes. So if this would have not been there, publicly traded stock, this would become a similar example to XYZ and ABC, where we can check the investees in financial statement.
Yeah, in that case of scenario, there is no custodian. Because private company, there are limited number of shares, and they own it directly.
Right.
Right, everyone on same page? Vineet, Kashish, Anjali.
Yes, sir.